Denise Chisholm, you take a probability-based approach to the market. So what are the probabilities telling you about stocks right now? How should investors place their bets?
Right. We really believe that history offers valuable insights into sector performance. So we study in that probability-based approach, we really study market history using our proprietary databases that go back to 1962 to really pull out key investment themes. And one of the key investment themes we've seen over the last year, and I think we'll continue to see play out over the next year, is what we call our profitability problems, or the fact that earnings growth, most ways you measure it, is now contracting.
All right, so talk about earnings growth. It was expected to rise in the third quarter and the fourth quarter. Where do you see it going?
So two things. I think that first, people think that earnings growth contraction means that we are likely in for an economic recession. When you look back through history, that's not always the case. Only half the time do you see profit contractions coincide with economic contractions. The second thing we hear quite often is that this is just an energy and materials phenomenon. Out of the data that I looked at, out of the 10 sectors we study, on a median basis, over half for all year have had median earnings growth that is declining. So we do see this as a broader market phenomenon. Again, what's critical now to answer for investors is, are profitability problems over, or are they just beginning? And I think history can offer some unique insights into that. First, the deterioration we've seen in leading economic indicators on a global basis, because this is actually a global problem, suggests that not only are we not going to achieve the lofty expectations for next year, but we are, unless things change and change rapidly, likely in for a more prolonged earnings contraction.
All right, so the odds are I should probably stick with utilities, which have done so fairly well this year, along with consumer staples, if I'm reading you right.
That's a great question, and that's a great point. So again, when you study history, you can say, have we seen the typical market response that we typically see during earnings contractions? And the answer is not all the way there yet. So what you see is what we call at Fidelity a defensive rotation. And that's that stable growth, earnings growth areas that you were talking about, like consumer staples, utilities, healthcare, versus the more cyclically exposed areas of, say, energy, financials, and materials, because you're more likely to buy things like toothpaste and go to the doctor and turn on the lights, and you might, in periods of uncertainty, forego that iPhone. What you see is we're only a third of the way through a typical defensive rotation as seen in a profit contraction. So that would argue that those stable growth sectors have longer to run.
Financials have been one of the market's laggards this year, serious laggard. Will that turn around once we get a Fed rate hike? It'll help their net interest margins. And a lot of people say in order to get a market to move higher, financials got to lead.
So we are seeing, in terms of historical probabilities, interest rates aren't the only thing that is meaningful to financials. What is actually more important than either that or loan growth is actually credit and delinquencies. We are seeing a deterioration in their C&I book, which off of very good levels, but we still are seeing deterioration. When you look back through history, you only have 30% odds of outperformance when credit starts deteriorating like this. Now, because of multiple compression, now you might say financials are cheap enough this time or it's different this time, but I'd say sort of buyer beware with what history is telling you.
All right, odds are we got to stay defensive, right?
That's right.
Thanks for coming on, Denise.
Thanks for having me.
And thank you for watching The Street.